Has the market run too far, too fast? What do the technicals say? Where are U.S. Treasury yields headed? All that and much more coming right up. Ed Harrison here for Real Vision. I'm talking to Katie Stockton, founder of Fairlead Strategies. Katie, welcome back to Real Vision.
It's good to be back.
And welcome to our inaugural view with you here on Real Vision Daily Briefing. I want to start off with the first piece of information that we're talking about, the market. When I spoke to you earlier today, you said the market's run up a lot. And then the question becomes, is that sustainable? What do you think about where the market levels are now?
Well, the run-up that we've seen is a bullish intermediate-term development because with it, we have seen a lot of breakouts from a bottom-up perspective. And by that, I mean individual stocks have been clearing former resistance levels on their charts. And for the most case, they're really short-term, sort of minor levels that have been cleared. So the implications in the near term are a little bit less exciting. Also, we've seen, of course, short-term overbought conditions become pretty widespread with the run-up that we've seen. I went back and I looked at instances when the S&P 500 had run up 6 consecutive days. And the last time that occurred was in late August. And if you recall, of course, we had a pretty sizable pullback in September. Not to say that it has predictive value, but what it does show is sort of a frothiness or a frenzied buying out there in the marketplace. And certainly we're feeling that not just in the S&P 500, but in the likes of the Russell 2000 index, which reflects small caps, which have outperformed dramatically. And then if in other asset classes or other assets, Bitcoin for one, lumber prices would be another. Within equities, you're seeing it on the sector front as well. Areas like electric vehicles or robotics or fintech, you name it, these hot spots have really done very, very well. And with that, you have extended intermediate term uptrends. The problem is that the support levels that are left in the wake of this very strong rally are now quite far from current levels. So when we do see a pullback, it could be pretty dramatic for the areas of the market that have run up.
Yeah, when you talk about support levels and some of the terminology you use, you're clearly talking about the technicals of the market, technical analysis as opposed to, what some people call fundamental analysis. And so I think it makes sense for us to stop here and think about the charts. What levels are you talking about? What do the charts look like? What are we seeing on those charts? Let's talk about the S&P 500 chart as an example. Where we've seen a run up, for a very long period of time. But we're talking long term, intermediate term, short term. Talk to me about the chart that we have up now, which you had sent over earlier, and what it's telling us.
Well, I like how you differentiate between the time horizons because that's really, really important to do, especially from a technical perspective, because the indicators that we use as technical analysts, they're all price-based. But if you're looking at them, say, on a daily bar chart, the implications will be short term. If you're looking at them on a weekly bar chart, they perhaps will be intermediate term. And on a monthly bar chart, they'd be long term. So it's really important to reconcile those time horizons. With the S&P 500, I think nobody would argue against the fact that it's in an uptrend. And with that, the moving averages are all pointing higher. And that's our bullish framework within which we view the intermediate and short-term indicators. So we take the same indicators really across these 3 time horizons and evaluate them. Now, the long-term momentum is very much positive. Even intermediate-term momentum is still positive behind the S&P 500, but to a lesser degree than we saw in the earlier stages of this intermediate-term up move. So if you compare the breakout that we saw in November, you can see it very easily on the chart there. That breakout was associated with newfound intermediate-term momentum. So it's kind of an early stage momentum buy signal. That breakout also leaves support around 35.88 for the S&P 500 based on the former peaks on the chart. Sometimes that level will be considered important to investors because for those that felt like they missed that breakout, they would be very eager to get back in at that level. So that's kind of the concept or market psychology, but behind that level. Now, over the near term, we've also seen the short-term indicators turn higher this month with the run-up that we've seen. And the breakout that we've seen just in the past few days or so is, of course, more minor in nature. And we're a little bit worried that it's going to be left unconfirmed, meaning that we don't see prices really hold up for a long enough duration to confirm that breakout and suggest that it's real. So what we would be wary of for the S&P 500 in terms of levels would be a dip back below that 3871 level, which is former resistance from January. Again, more of a minor level, but that would be a nice threshold to remain above in order to preserve the short-term momentum behind the market. So that's just one metric to watch in terms of short-term momentum.
Yeah, very good. And I'm looking at that chart right now as you talk, and I see the long blue line across. That's the first level that you were talking about, the support level, and then the second one across. That's the one that you just mentioned. Is that right?
That's right. So that's a more minor support level, and a dip back below that would be cause for concern in the near term, really only for a short-term pullback or consolidation phase within that bullish context. So when we do see weakness from a top-down perspective, starting with major indices like the S&P 500, you can imagine it trickles down to just about every individual stock. So top-down oriented weakness can be very painful, right, for all of us. But what it does is it actually regulates the sentiment behind the market, which arguably has become a little bit overly bullish. You can look at measures like the CBOE volatility index for a gauge of sentiment, sort of from a transactional standpoint. So that VIX is very depressed right now, but it has support around 20 that we think it might bounce off of, associated with a pullback in the S&P 500. So there's a few other things that we're keeping an eye on to help us kind of get that entry in terms of the pullback. But really, at the end of the day, we're hoping to use that weakness or consolidation in the coming weeks to add exposure to take advantage of those longer term trends. Now, I think we can all agree that we'd love to see some kind of consolidation in the likes of Bitcoin and these other steep uptrends that many people feel like they've missed, and they wonder if it's ever going to come back in.
Right. Yeah. I mean, that's a good segue into thinking about individual shares and potentially talking about specific sectors. I was thinking of a quote that you gave me earlier today. You were talking about steep up moves. They need pauses to refresh, and we're at a point where the market's overbought. It made me think about Tesla in particular. You had a view on Tesla in terms of the 20-day moving average. Maybe you can talk us through that.
Yeah, the moving averages can be great gauges of the trend over different time horizons. The 20-day moving average is pretty short term, but what we sometimes use it for, when you see a steep uptrend like we had previously in Tesla, and that 20-day moving average goes from trending up to then flattening and trending sideways, that tends to be a decent environment in which to stay on the sidelines. So that's what we saw really just this week in Tesla, not helped by yesterday's decline. So I think that that's a meaningful loss of momentum behind a heavyweight, of course, in the S&P 500 and major indices. So something to make a note of. It's not really broad-based yet. So for the most part, we have those 20-day moving averages still very much pointing higher, including for the major indices. So it's not a broad-based issue, but it shows a potential kind of chink in the armor of the market.
Yeah, and when you talk about other places that were seeing some heavy buying, you mentioned Bitcoin right at the beginning. You mentioned it later. You also mentioned lumber. Basically, more broadly, we're talking about risk-on positions that people are having. To a degree, the consensus seems to be it's fueled by retail investors. And going back to your thinking, there's a fear in the market that you could get a dramatic reversal given how far the major support levels are below where we are. Would that support level qualify as a correction? How far down would we be going if you get to those levels? And what happens underneath those levels?
Yeah, that's right. So, I mean, the support is a good gauge of downside risk when pullbacks do unfold. In and of themselves, they're not really a risky indicator per se. They just kind of give you a sense of where the buyers may step back in when momentum falls off, which, of course, we really haven't seen in the likes of Bitcoin. Now, when you look at something like Bitcoin, the support levels, even based on something like the 50-day moving average, are very far below. I think 30 to 31,000 was a level of importance for Bitcoin on the downside. And as it fast approaches 50,000, that of course is a very meaningful percentage decline if we were to see a pullback of that magnitude. So it just tells us that, listen, there is heightened risk associated with these steep uptrends. And the only way to either manage through that is by paring back positions or putting on hedges, or using a stop loss discipline that you feel some confidence on, and whether it's based on percentage declines or something else. The only real risk of that is, of course, if you see some kind of gap down, which would be driven by a catalyst that is unlikely to be technical in nature.
Yeah, and I think that while you were speaking, we had the chart up for Bitcoin, so that's good. I'm thinking about the larger nexus. Bitcoin, to a degree, you could say that there's some retail buying there. There's certainly some retail buying with regard to the frenzy, and we saw that with GameStop as an example. I was telling you earlier when we were thinking about this, you're coming on, that I was thinking of it from an index perspective. If we look at indices like the retail ETF XRT, which you mentioned to me, GameStop being a part of that, maybe you can walk me through how XRT is faring in terms of this whole nexus of retail investors coming in and driving stocks higher, where the support levels are and what the individual stocks like GameStop mean for those indices.
Yeah, that's right. I mean, when you have these very big squeezes, even in a small security, they can have a pretty major impact on benchmarks, whether they're indices or ETFs. And you really saw that in the retail sector over the past couple of weeks. You saw those stocks that were run up with that retail trade or the Reddit trade, whatever you want to call it. They became a much bigger part of XRT as one example of an ETF representing retail. And with that, of course, the XRT got stretched farther away from its 50-day moving average, farther than we've seen in recent history. And again, that's not in and of itself a risk, but it does suggest that there's more risk when we see the loss of momentum. And indeed, we've already seen that loss of short-term momentum, certainly behind GameStop, and also benchmarks like XRT that really got run up in that environment. So I think the 50-day moving average is just a good gauge of the prevailing intermediate term trend, and also can be a good gauge of support when we come down and pull back. And that was the case for the S&P 500 recently as well, kind of pivoted right at its 50-day moving average. So it does hold relevance. That's in part probably because so many eyes are on it. So many people are watching these 50-day moving averages as an input in their trading. So I think there's a reason that you find some support coming into play around those moving averages. But more importantly, even than support in terms of gauging downside risk, we like to look at indicators that tell us when a security may be oversold. And these indicators are mathematically driven, and they give you really a black and white result in terms of, is this an oversold buy signal or not? So we look at those indicators in conjunction with support levels.
When I just look at the chart, the XRT chart, what I see is a trend line in the purple that is broken, with the massive, almost parabolic move up, and then, a cratering back down, and since, last week, a movement that is pretty much in line with the prior trend line. What are we supposed to make of that? Because basically that's the whole GameStop, meme stock run up and then crashing. What kind of impact does that have?
Well, on the chart, it would be a negative impact because with that run up and decline, it's yielding overbought sell signals. So the same indicators that we're using to understand when there's an entry perhaps at hand help us understand when there's probably an exit underway, even if it's short term in nature. So these are just short term overbought downturns that we've seen with that decline, but that's exactly what generated it. And it doesn't discriminate. These mathematical indicators do not discriminate on the reason why that happened. It doesn't matter if it was GameStop, or which you could argue was a falsely driven rally, or something totally different than that. It's just price action, right? We really need to respect that price action, and the indicators help keep us honest because you can't argue against the signal.
I want to end this discussion with the 10-year Treasury yields, but I think it's interesting when we talk about the indicators. I mean, nowhere in the conversation thus far have we talked about the macro factors that are influencing X, Y, or Z. We're really just looking at the charts, the technicals, et cetera. Now, when you think about it from your perspective, when you're doing your analysis, how much do these other macro, you could even say confabulation in certain cases, is the reasons that people are creating enter into how you're thinking about an index or a particular stock?
Yeah, I mean, listen, I think there's maybe 3 or 4 pillars of investing, and it's fundamental, macro, technical, and some would argue political, one way or the other. So with all of those things on your side, I think that's where you're going to have the best positions. Of course, that's somewhat difficult to find and discover in different ways. The technicals or the charts are really all price based. So we're letting all of that inform the decision to buy or sell, and the supply and demand for not necessarily the company's products, right? But for the stock representing that company. There are, of course, times at which that stock doesn't really act in line with the company's performance. So I think the technicals help us navigate that gap, if you will, when the price action is really more market driven or even macro driven. Rarely ever is something technically driven, unless perhaps it's a major breakout or something that widely followed, like the 200-day moving average is in play. But we're here not to answer the question why something's happening, but really what is happening and how does that inform our positioning from a risk reward perspective.
Right. So meaning that if you can inform clients who would then therefore they might look at those other 3 risk factors and create a holistic view, but you're giving them one part of that, and they can use that to inform them in their holistic view.
That's exactly right. So we publish research for subscribers, and they run from very sophisticated hedge fund managers to the retail investor who has very, very little experience whatsoever but wants to do it themselves. So we're providing them one piece of the whole puzzle. And unfortunately, we don't have the expertise to do the rest. So we trust that they're doing that on their own, but hoping that it's not just all the technicals that are driving your decisions. They're really there to help with market timing, with risk management, and asserting a directional bias, which of course can help you just be more successful in investing.
Yeah, and speaking of directional bias, I think just from a macro perspective, what's on a lot of people's mind is the 10-year, because the bottom of the curve is penned at 0. The 10-year had been trending up. People are talking about inflation, and then people are also talking about this whole long duration play of equities, meaning that if the 10-year goes to a certain level, then potentially that could have negative implications for equities and other asset prices that are longer duration assets. And so I think it's interesting to run through the chart, the technicals for the 10-year Treasury yields, because there are, to me, when I look at the chart that you have in terms of the blue lines across, there's definitely there's some trading ranges that were violated earlier this year, and I want to get a sense of are we looking to violate those another range or not?
Yeah, I mean, it's definitely worth discussing. It's certainly a topic for this year to date. because we saw Treasury yields on the 10-year exceed that 1% threshold. And 1% holds psychological significance as a round number, but it also was resistance, meaning previous highs on the chart. So when we saw that level cleared, that marked a very significant base breakout or trading range breakout. And the targeted level from that breakout becomes about 1.5%, very simply, based on the width of the base and also where there is next resistance on the chart. In that case, it's from previous lows. So it's a very natural place for something to stall at previous lows when it's coming out of a downtrending environment. In the interim, if you can see on that chart, there is some resistance around 1.14%, and it's based on something different, which is called the cloud model. It's a trend following gauge. It's a little bit obscure, but it adds a lot of value to our process by helping us understand what the prevailing trend is and also where there might be some headwinds on a chart. And indeed, the 10-year Treasury yield does have headwinds in here based on that model. But if you can see by its curvature, it does support the longer term turnaround that we believe has occurred. And you can see it also in the long-term momentum gauges.
Yeah, that space, that purple space in the chart, I think is interesting. Can you walk us through, the green line at the top, red at the bottom, and the purple space in the middle? Because we're at a point, it seems that there's a bit of a narrowing of the channel going forward potentially.
Yeah, so without boring you to tears in terms of the construction of the indicator, consider it a trend following gauge. It's based not on moving averages of price like many are, but rather midpoints of price. And therein it gets that kind of jagged quality where it plateaus at different times. The reason it does that is because when it was developed, which is hundreds of years ago, there were not the systems that we have in place now to calculate things quickly. So that's really the only reason for that look to it. When you see it thinner, it tends to be easier to surmount one way or the other, so that there are some implications of the width of that so-called cloud. But when you see a breakout above the upper boundary, that's when you have a shift. So in charting, we're always looking for breakouts and breakdowns. And there is subjectivity in terms of what levels we're adhering to for resistance and support to identify those breakouts and breakdowns. So that's where a lot of the art of technical analysis comes into play. So the upper boundary being right around that 1.14% level, that to me is a significant level. If we stay below it here in the near term, it would support, I'd say, several weeks of consolidation for Treasury yields. Now, ultimately, we are looking for a breakout again, just on the back of what we saw recently from that 1% level. And I agree, there's going to be a level at which it becomes a cause for concern for the equity market. However, I don't think anybody can assign that specific level for one, and I think we're probably pretty far from it. Treasury yields tend to kind of stair step. Rarely ever do they sustain steep up moves. So I think we can trust in the fact that perhaps it's a gradual trend that's unfolding here.
Yeah, only time will tell. But my last question on that is, given that we moved into this new trading range above 1%, we have this resistance at 114. I'm thinking back, I remember there was a spike up to 119. We retraced back down below that 114 level. And now for the last few days, we've been above 114. As we speak, the level that I'm looking at is like 116.5, which would suggest that, yes, we've tested resistance and we're in the process of potentially breaking resistance. Is that the right way to think about it?
Yeah. So the way I look at breakouts is maybe different from the next technician, but I look for breakouts to be confirmed on a closing basis, and with a major level, usually a consecutive closing basis. So a lot of intraday or intra-week price action or action in yields can be somewhat unsustainable. So we really give more weight to the close. And for an intermediate term level like this 1.14%, we would look to see consecutive weekly closes or Friday closes for Treasury yields above that level. That would confirm a breakout in our eyes. And that discipline has helped us miss a lot of false breakouts or whipsaws. And I think it's something that just kind of keeps us, it gives us confidence in breakouts as they unfold, as opposed to reacting too quickly. I think we're all sort of prone to reacting too quickly at times, and it's really a preventative mechanism in that regard.
Great. Well, Katie, I really appreciate the education, and I'm looking for those Friday closes of the 10-year in particular. I think it'll be very interesting to see because, only time will tell how far we can go up from there. Thank you very much.
You're welcome.